You slip your money across the counter, secure it in an account, and naturally assume your loyalty guarantees the best rates. It is the standard set it and forget it philosophy. You find a reliable bank, automate your deposits, and let the interest accumulate in the background for years. But for millions of people banking with Capital One, that exact passive strategy resulted in a widening gap between what they were earning and what the bank was paying newer clients. In the financial industry, this is often described as a loyalty tax. Trusting your bank to automatically migrate you to their most competitive product can result in a quiet depletion of potential wealth. This particular discrepancy eventually sparked a massive legal confrontation. The timeline of this conflict starts in September 2019. That is when Capital One introduced a new financial product, the 360 Performance Savings Account. The issue boils down to a discrepancy in yield. This new account offered higher interest rates than the bank's older, almost identically branded product, the standard 360 Savings Account. While new money flowed onto this steeply rising performance line, existing customers were kept on this flat, lower interest trajectory until mid-2025. Over 6 years, the mathematical gap widened. That filled space represents the interest loyal customers missed out on. By failing to explicitly communicate this internal product shift, the bank left long-term customers with a lower yield than the new product offered to everyone else. That discrepancy led to a class action lawsuit. Customers who realized they were stuck with the lower yield argued they were deceived by the rollout of the higher rate accounts. Capital One's official legal stance is clear. The bank denies any wrongdoing or illegal deception regarding how they managed the two products. However, on April 20th, a judge officially approved a $425 million settlement. Regardless of the denial of fault, the scale of this settlement demonstrates that leaving loyal customers in outdated financial products carries immense corporate liability. If you held one of those older accounts, you likely want to know how much of that $425 million actually belongs to you. Payouts aren't flat fees. The calculation multiplies your specific account balance by the missed interest rate gap. First, mandatory deductions, legal and administrative costs, are subtracted from the total settlement. Finally, the remaining pool distributes proportionally, based on the interest you personally lost. To be part of that group, you must fall inside a specific eligibility window. You had to hold the 360 savings account at any point between September 18, 2019 and June 16, 2025. This payout structure functions as restitution, intended to restore the yield you would have earned if your money had been in the higher rate account. Receiving those funds requires very little effort. Eligible account holders do not need to file a claim. The delivery method is automated. Physical checks will be sent in the mail to the vast majority of qualifying customers. There is one exception for micro payouts. If your calculated settlement amount is under $5, the money will only be distributed electronically. For those who prefer digital deposits, there were timing constraints. Customers had to manually opt in for electronic payments before a March 30th deadline to avoid receiving a paper check. The legal system is prioritizing automatic distribution over complex claim forms, aiming for the widest possible restitution. As for the timeline, assuming there are no legal appeals to delay the process, the settlement money is expected to be sent on or about July 21st. For hundreds of thousands of people, checking the mailbox this summer will reveal the official documents and payments marking the end of this case. Retail banking incentives are constantly shifting. In the modern market, the highest rates are often reserved for attracting new deposits, while older accounts remain at previous levels. This means consumers must actively audit their set and forget accounts regularly. Assuming your bank will automatically prioritize your yield is a risk that many customers have now seen quantified in court.